Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Sofi Technologies SOFI stock and how they are supposed to deliver an earnings beat for their overall EPS as well as their revenue. So we're going to be diving into their latest news updates as well as price predictions. Then we're going to move on and talk about Affirm stock and why it has plummeted recently so we can determine whether or not we should buy, hold, or sell this company considering the current stock market environment. As always, we will also be going over the latest price predictions for this company as well. And then after we talk about Affirm, we're going to move over and talk about Carvana to see if the current economy is favoring companies like Carvana, which are selling used vehicles. So we're going to take a look at the used cars market. Then lastly, we're going to conclude the video by talking about Bill.com Holdings and what 12 analysts have to say about this particular company. So for more videos just like this one, remember to go and smash that like button right now, comment your thoughts down below about any of these four companies, subscribe if you are new, and without further ado, let's jump into our first story, which is Sofi Technologies and how they are anticipating an earnings beat coming up. So I've already said that I am holding this company considering the current stock market environment, how I've stopped buying up the company. Right now I have a 4% allocation to it because the current macroeconomic environment is just too risky right now. Sofi Technologies is a fintech company or a financial technology company that offers their consumers an all-in-one inclusive digital app which gives them access to various financial services and or financial products. Right now the current share price is trading at $5, while professionals believe it should be worth anywhere between $6 and $11 over the next 12 months, and this particular article and author believes that the company is going to have a fantastic earnings report which is going to come out on November 1st. So please mark your calendar for that. I will also be doing an analysis video when that comes out. However, despite the current macroeconomic environment that we are in, which is very bearish and negative, Sofi Technologies actually revealed very surprising earnings for their Q2 report, and many people and investors believe that the same thing is going to happen for their Q3 earnings report, to where Sofi Technologies is going to deliver an EPS and or a revenue surprise, thus beating analysts' projections. And the main reason for this is going to be attributed to personal loan demand and personal loan growth. So let's dive into what we mean by that. If you've looked at the overall trend of personal loan demand, it has actually increased across the entire financial and fintech space, which is somewhat surprising because normally during an environment with increasing interest rates, you wouldn't think that personal loans would actually increase and that the demand for this certain product would be on the rise. However, ever since 2012, we can see a steady increase in overall personal loan demands, which Sofi is taking advantage of because they offer very competitive personal loans at a very competitive interest rate. Despite the weakening economy and the negative macroeconomic outlook, it seems that Americans specifically are taking out more personal loans than usual. Why? They're using this money to pay off other debts and credit cards. And the main reason why they are attaching themselves to the personal loan products is because as inflation and as interest rates increase, personal loan rates are actually fixed, which means as interest rates increase, the personal loan rate is going to stay the same. So while things get more expensive and various flexible interest rates increase on other loan products, personal loan rates are fixed, so they can use the money from their personal loan to quickly pay off other forms of debt at a fixed rate, which is actually pretty smart. Therefore, that's causing a surge in overall personal loan demand despite an increasing interest rate environment that we are in right now. And this favorable trend is anticipated to continue well into the future, which is benefiting both banks and fintech companies. The author goes on to say that it's logical to conclude and argue that Sofi, based on this personal loan demand, will actually outperform expectations in their upcoming earnings report. Sofi Technologies has also illustrated that they are growing both their members and their overall product demand. And as you can see on screen, we can see both their member growth and their product growth, which are exponentially increasing, which is absolutely phenomenal. This is exactly what we would like to see as investors in this particular company. So this is very bullish. Also, even after the earnings report, whether or not that's positive or negative, once the new year starts and the student loan moratorium moratorium ends, where students, or rather former students, are going to start paying back on their student loans, and they will be required to do so on top of those specific student loans increasing in their overall debt load due to the interest rate also being reenacted on those particular loans. This is also going to drive demand up for another SoFi product in their lending segment, which is the largest segment for SoFi Technologies that brings in the majority of their revenues. So given the fact that SoFi is increasing their overall membership, their personal loan market demand, as well as their demand when it comes to student loan refinances, this is going to reflect very positively on the overall results that SoFi is going to bring in for their earnings report again, which is going to be on November 1st. So hopefully they can have a beat when it comes to that. Now, I don't know if they're going to beat on it. However, they do have a track record of consistently beating their overall revenues. So it wouldn't surprise me if they beat their revenues, but their earnings per share, that's something that we need to look further in at, because right now on the current projections, the current forecasts and projections have this company becoming a profitable company in the year of 2024 toward the end of that year. Now, there is a problem with increasing of personal loans, and that's why I want to point out the risk for this overall occurrence in this particular company. So personal loans are very good for banks and fintech companies because they get a lot of revenue from these. However, the delinquency rates and the people defaulting on these loans are relatively higher compared to other loan products. And we especially see this during times of macroeconomic uncertainty and or recessions, where people tend to default on their various loans even more so during that particular economic occurrence, such as a recession. But according to Experian, the delinquency and default rates for personal loans have historically been at lows. As you can see from this current chart on screen, you can see that the delinquency rate is actually extremely low, reaching back all the way until 1987. So I really don't think this is a very good bearish perspective that some bears are throwing in the face of SoFi Technologies. Many investors are actually very excited about SoFi Technologies, not only due to the fact that they are increasing their overall products because they plan to issue new products, they also have a very strong balance sheet on top of growing their revenues at an astounding rate of over a 40% CAGR, which is their compounding annual growth rate. Fundamentally, the company has a strong balance sheet of around $700 million in terms of short-term cash and or cash equivalents, which currently makes up around 10% of their overall market capitalization. And they also have a very competitive total liability to asset ratio of 56.5%, so this is very positive. Now, what the author doesn't include here that I will include is that if you look at their overall debt, they have over $3 billion worth of debt. So comparing their very large cash reserve to their overall debt is probably not the best place to argue in terms of SoFi being a fundamentally strong company, but I do like the management of this company, and I do think that after the current negative economic environment that we are in, this company could surge back up in price. But until then, we should definitely look forward to their earnings results, which will be released for quarter 3 of 2022 on November 1st, so I will keep you posted for that. Moving right along here onto our next story is going to be why Affirm stock is plummeting both on Friday and Monday of the week. Now, I actually have a hold rating for SoFi Technologies, but a no rating for Affirm, which means I don't think this is an opportune time to buy this company. Currently, Affirm is trading at $18 per share, while professionals and experts in this particular space believe the company is worth anywhere between $15 on the low end and $53 on the high end. Affirm, ticker symbol AFRM, has seen a steady decrease in their stock price for the last year. And this is a very well-known buy now, pay later company, which also is a fintech company. So essentially, this company allows consumers to buy things and then pay off that debt later. However, I would say the majority of users would just use a credit card, but Affirm clearly has a competitive advantage in this particular space, and that's why they are a company. Most notably, I actually want to point out that Companies like Affirm, buy now pay later companies, will be hit extremely hard during times of macroeconomic uncertainty and a recession, because consumers will be less likely to buy products and therefore not buy now and then pay later. If anything, investors and other consumers are going to be more stingy and stringent for what they actually buy. This is going to lead to various people eating out less and shopping at grocery stores more, and also paying off buy now pay later companies as well as credit card debt during this particular time. So companies and fintech companies like Affirm will actually be hit very hard. And we actually see this from the data because as of September, particularly for that month, consumer spending was flat according to the Commerce Department's retail sales report. And because this consumer spending is flat and could even downtrend, stocks and other companies that rely on buy now pay later or debt are going to decrease, such as Affirm, and that's why I have a not yet rating for this particular company. Now, for Affirm investors, this was not comforting news to know, and we could see the stock price fall even more. I would say this company could fall to around $15 per share and or lower, considering the current stock market environment, particularly because companies like Affirm do not do well in times of high inflation and increasing interest rates. Affirm, though, continues to grow their revenue and add new customers, which is very positive, but this has been overlooked by the decrease in their overall stock price of around 82% over the last year, to where currently it trades for around $18 to $17, and on top of that, this company is not yet profitable. Plus, this company being in an extremely competitive industry right now is just not the best time to buy this company. Now, I do want to point out that their next quarterly earnings report will be on November 9th, which will give us better visibility on the future of this overall company. So hopefully, I wish investors the best if you are invested in Affirm. However, I personally am not. I am just not comfortable buying this company at the current stock price. With that being said, let's move on to our next story, which is Carvana, ticker symbol CVNA, which basically offers people the way to purchase cars over the internet where it will be delivered to them, and they also buy up used cars, and that's why the used car market is going to be a good indicator on where the Carvana stock price will go in the future. The prices for used cars has absolutely skyrocketed, but lately it's been cooling off, which is going to mean that this company is going to cool off as well in its stock price and its overall revenue. Right now, Carvana, which sells cars, used and new, currently trades for $14 per share, while experts in this particular space believe the company should be worth at $15 at the minimum and $100 at the maximum. Again, I have another no rating on this particular company. I just don't think this is the current environment that we would want or feel comfortable buying this particular company in. Now, this doesn't mean that this is a bad company. It just means that right now may not be a good buying opportunity for this particular company. And this sentiment of mine is backed by the Wedbush managing director, who says that they are actually downgrading Carvana to a neutral rating from an outperform rating. But why? Wedbush decreased the stock price target for this company for two main reasons. The first one being that they don't believe that Carvana has a viable business model considering the current stock market environment, and I would agree with them. The second reason why they have actually downgraded this company is that the current market is moving against them. We are seeing used car prices plummet in their overall prices, and they are declining by double digits year over year right now, which again is going to force this company's stock price even lower. That's why Wedbush and other companies and analysts have a $15 price target for this company, and in the meantime, they are going to stay on the sidelines. So clearly they have an underperform rating for this company. I would probably hold this company potentially, but considering that the current stock market is moving against them and they don't have a good business model, considering the current negative macroeconomic environment, again, I have this as a no rating. But I would love to hear your thoughts down below. And then lastly, moving on to the final stock of this video, we are going to talk about Bill.com Holdings, ticker symbol BILL. So we're going to see what 12 analysts actually have to say about this particular company. Well, analysts are actually very bullish on this company, where two analysts are very bullish and 10 are somewhat bullish, where we have no analysts, at least from this source, saying that they are indifferent, that they're bearish, or that this company is a selling opportunity, which is very interesting. Now, overall, I would say that this is a company to hold. I would rate this company as a hold right now because they are not a bad company by any means. However, again, considering the current stock market environment, I bet you this company could drop lower in their overall stock price. Currently, this company trades for $125 per share, while analysts believe the company could be trading at anywhere between $110 on the low end to $300 at maximum, with the majority of analysts saying to buy this company. Out of 22 analysts, actually, 20 of these analysts say to buy the company, with only 2 analysts saying to hold it, while none of the analysts say to actually sell this company. So overall, this could be a good company to hold in your portfolio if you do more research on it based on your personal risk tolerances. If you didn't know, Bill.com Holdings Inc. is a provider of cloud-based software that digitalizes and automates financial operations for small and mid-sized businesses. Overall, they have very good artificial intelligence technology, and this makes the management of money from a small business perspective very achievable. So again, this company is pretty good at what they do, and I do like the future stock price targets of this particular company, because even if the bears are right of this company, it's just going to trade sideways for the next year and stabilize. But if bulls are right for this particular company, once we come out of this negative macroeconomic environment, we could see this company to surge up to around $186.50 per share, according to this particular Benzinga article. But I would love to hear your thoughts down below on this company and the other companies that we talked about in this video. Remember to go and smash that like button for more stock news updates just like this one, and I will see you in the next YT video.